Now that we're in an economic environment where we are seeing some recovery, it's a slow recovery, but at least it is, everything seems to be going in the right direction, you can feel better about the fact that companies are going to be able to pay their rent. Renters are more likely, individual renters in apartments are more likely to have a steady job at this point and to feel good about their job, and maybe even their personal balance sheets are in better condition than they had been, and so the ability for an individual renter to pay their rent, everything just seems a lot more, I don't want to say sure, but you feel better about the prospects of your income stream and your cash flows coming out the way that you expected them to, and maybe even improving. And really that's how people are investing right now in many of the sectors, is with an eye toward increasing cash flows, not decreasing. The specter of interest rate increases is certainly one of the things that everyone's challenged by at this point, trying to figure out when and by how much, because there will be some correlation, especially if you don't have a lot of income improvement that is occurring at the same time. And if you think about how low cap rates are right now, even a small 25, 50 basis point increase in cap rates is such a huge percentage of where the current cap rates are right now, just from a math perspective, that it's hard to see where there isn't some impact. But we're really not concerned that there's going to be any near-term impact or that it's going to be an extreme impact, because we really do believe that if interest rates start to go up, and when interest rates start to go up, it's going to be accompanied by an increase in an improvement in economic conditions that will lead to also an increase in income, therefore offsetting somewhat the cap rate expansion. As the market is recovering, there's been a lot more discussion of investors moving a little bit further up the risk spectrum into value add, and maybe even for some people opportunistic investing. And I feel like I started hearing about that last year from institutional investors, that when polled in early January of 2012, they indicated they were not going to be making a lot more core investing, and they were going to be moving up the risk profile. But at the end of the day, you didn't really see that happen in 2012, and now it's sort of the same trend that's occurring in 2013, that there's definitely discussion of a lot more value-added investing, a lot more opportunistic. People have the appetite for more risk. But again, you just don't see that much of it actually happening. You see a lot of it being talked about, and there are certain players like a Blackstone that are always going to play in that space. But in terms of sort of the broad institutional investment arena, you haven't necessarily seen that migration away from core yet. And part of it could be that every time there seems to be some moderate improvement in the economic environment, there's a little bit of a step backward that then recalibrates people back to core, and then they have to start off on that path again, even just sort of emotionally, as in terms of feeling good enough about where things are to take another step up on the risk spectrum. So that's something that we've definitely seen as a trend, although it's more of a talked about trend than a trend that's actually come to fruition.